Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. And today we have a really interesting show, very timely show. We're going to be joined by Tom DeWitt and Lou Wessel from Robinson Grant, CPAs here in Hilton Head, going to be talking to us about South Carolina taxes. Very timely topic for those of us that are obviously filing late. We file an extension. October 15th is looming, so it should be a pretty timely and interesting topic for those of you that are still looking to file your taxes or maybe need to amend your taxes after you listen to the show. But before we get to that, definitely want to talk a little bit about what's been going on market-wise, because we've had just a very tumultuous couple of weeks, and certainly last week was no different. We're probably not looking at anything different this week. We still have our situation in Europe, specifically the Greek debt situation, looking to unwind that debt in as orderly a fashion as possible. The markets are really just sitting on pins and needles right now, waiting to see what happens with that, hoping that the EU is able to unwind that debt, recapitalize that debt in some type of an orderly fashion that will also signal to other European countries that their debt perhaps can be recapitalized in an orderly fashion without the EU necessarily falling apart. So there's a lot of fear and uncertainty around what's going on in Europe right now. On top of that, those fears are also exacerbated by the thought that we could see a slowing in the growth in China. That's nothing that we've heard over the last couple of years. China's been going gangbusters, but for the first time we actually heard that Chinese growth might actually be slowing. Still going at a rapid pace, somewhere around 7.5% growth expected for the year, but that's down from a rate of around 10%. So the concern is that if we're seeing a global economic slowdown and China's also slowing down, which is something that hasn't happened in the past, at least the past few years as we've been pulling ourselves out of this recession, that could further destabilize an already unstable or uncertain economy. This week we have Bernanke speaking to Congress again today, not expected to move the markets too much. We also have a jobs report coming out later this week that's going to be highly anticipated. Wouldn't be surprised if we do see the market move around that, although there's always, a certain level of anticipation around that. And by and large, I think that if you're listening to any news broadcast, they're going to be talking about how it does feel like 2008 again. And here's my little pep talk that it's not 2008. Things actually are a lot better economically now than they were in 2008. For example, banks are better capitalized now than they were back in 2008. Corporate balance sheets are healthier now than they were in 2008. Earnings, most corporate earnings have actually been steadily increasing. So by and large, fundamentals are actually stronger now than they were in 2008. So even though the negative sentiment seems to be pervading, it's worth considering the fact that fundamentally our economy is actually stronger than it was when we hit the recession that started in 2008. So do think about that as you're hearing all the negative sentiment on the news. So without any further ado, please join us back here in just a second. We're going to be joined by Tom DeWitt and Lou Wessel of Robinson Grant to talk about South Carolina state taxes. We'll be right back. I'm Emily Johnson, and this is Money Matters.
Hello, this is David Kroll from Mortgage Network. I want to speak today about a very basic topic, and that is interest rates and the relationship to the stock market. When the stock market goes up, it goes up because of good economic news, whether it be nationally or internationally. When the stock market goes down, it's because of bad news. Guess what? Rates come down at the same time that stocks come down. The bad news is the friend of the mortgage market, and it's the friend of the interest rate market. So the two markets function unequally, disequally with one another, and whenever you hear good news, you say, oops, the rates are going away. And when you hear bad news, you say, okay, rates should be getting better. That's my Mortgage Minute for now. Thank you.
Welcome back to Money Matters. I'm Emily Johnson, and I'm joined today by Tom DeWitt and Lou Wessel, CPAs with Robinson Grant here in Hilton Head. And we're talking about a very timely topic, at least for those of us who have filed extensions and have our taxes due October 15th, looming deadline. We're going to be talking about South Carolina taxes. And I know a lot of people often overlook state taxes, thinking that they're small compared to their federal tax burden, but in the state of South Carolina, they're actually pretty hefty. So we're going to talk a little bit about what those taxes are and perhaps how we can minimize them. So just to get started, tell me a little bit about why state taxes in South Carolina are so important, the size, et cetera.
I mean, just sheer dollars alone, the fact that our top marginal rate is 7% and starts at a little over $13,000 in taxable income.
So it's a pretty low limit.
It's a pretty low limit. I mean, basically everybody that's going to pay South Carolina taxes is going to pay at the 7% level. Mm-hmm. And that's something that gets my attention, that's for sure. 7% is pretty hefty. Mm-hmm. So, I mean, if you're looking for different ways that you might want to reduce that,
is South Carolina, are there opportunities within or for South Carolina residents to reduce that? I know one thing that we've talked about before is muni bond interest. I know that you and I have talked about anyway. How is muni bond interest treated in the state of South Carolina?
As with, and Tom, I'm sorry, jump in anytime you want, but as with really every state in the nation, a state income tax, municipal bond interest is not taxed federally. Mm-hmm. The nice thing about South Carolina, again with most states, is if you have a South Carolina municipal bond, it's not taxed in the state either. So mm-hmm. you get an extra 7% kick.
How much volume is there for that? Do you see much when you're doing tax returns? Do your clients wind up with a lot of South Carolina muni bonds, or do they defer to, say, the highest yielding bonds in Georgia or Washington, D.C., or
what probably have more experience with me than I do.
No, most of them do concentrate on the state that they're residing in to mm-hmm. get the municipal bonds. But there again, with if it depends on their tax bracket, there could be good reason to have some bonds from other states, particularly with seniors who get other exemptions.
Mm-hmm. Now, some of the other places where, was it Washington, D.C., and is it Puerto Rico? Tell me a little bit about the muni bond interest on those locations.
The municipal bonds from Puerto Rico or any subdivision of the United States are also exempt in South Carolina.
Okay, interesting. And tell me a little bit about real estate losses. I know we have a lot of investors in real estate as well as, of course, primary, secondary homeowners here. So what happens if you sell a home for a loss, which is unfortunately what is happening to a lot of folks these days?
If it's a personal residence, it's a personal loss and it's not deductible for either state or federal income tax purposes. If it happens to be rental property, then you can take those losses, and they're what we consider 1231 losses, and they can also be ordinary losses to the extent that you have ordinary income. And so distinguishing that between a capital gain and an ordinary loss, a capital gain is limited to $3,000 per year, but a 1231 ordinary loss would be unlimited and totally deductible against any other kind of income that you may have.
Now, what determines that? Is that if you're in the business of real estate, or how does it become deduction against ordinary income?
Real estate has a special place in the tax code, and so there are special rules about real estate. So it doesn't have to be commercial. It could be residential or commercial to be considered 1231 property and to get that ordinary deduction. And so it just has a special purpose and treated very favorably under the tax laws.
That's really interesting. Is that unique to South Carolina, or do most other states have that same? I mean, I'm asking you something that's out of your purview, and I apologize, but is that unique to South Carolina, or do many other states have that same distinction?
First of all, it's a federal law, and South Carolina follows the federal law. Other states would follow the federal law as far as it goes, but there again, it would depend on those other states. Most states follow what the federal government does.
And I know now with folks selling houses at a loss sometimes, or investment property, et cetera, at a loss, sometimes they're going to be selling also at a level that's below the mortgage that's due on them. What's your experience with that as far as what you've seen and how different banks are handling that? I know it seems to be on a case-by-case basis right now, since there's not a definite rule as to how that's handled.
I'm sure that there are rules. A lot of them are muddled because people do not know, and they cross lines. Is it a legal question, or is it an accounting question,
right,
or what kind of question is it? And so, you know, it is sort of muddled. But generally speaking, that any time that you have, you sell a personal residence at a loss, is that loss is not deductible. And if there is some debt forgiveness, that debt forgiveness will not be taxable under a special law that has been passed, I think goes through 2012.
Yeah, that's important to know that deadline. I wonder if they'll extend that given what's going on with the housing market now. Who knows?
Yes, any law, yes.
Exactly. Well, we'll write our congressman about that one, along with many other things.
I'm sure everybody thought the recession, or at least that we would be further out of the recession than we are by now.
Absolutely.
The one other issue we talked about in real estate, as far as state laws, if the real estate is not in South Carolina, it's excluded, its gains excluded from South Carolina income, and its losses are excluded from South Carolina.
Really? But would you be taxed in that state?
You would be taxed in the other state, correct, unless
it's held in a trust.
Unless, of course, it's in a state that doesn't have state taxes.
Interesting. Huh. So I'm sure you counsel people on that as far as, you know, how they title things and everything around this time of year.
It really is. It's where it's cited. It's not.
Oh, okay.
It's not so much the title. So.
Okay. Interesting. I didn't know that either. So, you know, one thing that I never really hear much about whenever you see the best places to retire is I never really see South Carolina listed as one of the best places to retire. It's often one of the best places to vacation, best golf, but never really the best place to retire. And I know you had mentioned to me that there are a lot of tax benefits to living in the state of South Carolina as a retiree. Can you tell me a little bit about those? Whichever of you would like to attack that one.
There's lots to talk about.
I'll start off. Okay. First of all, if you're 65 years old, there's what we call a 65-year-old and older deduction, of $15,000 per individual.
Wow.
And it's not income specific on a joint return. So you and a spouse and a husband can have a joint return. As long as they file on a joint return, they would get $30,000 if both are over 65.
Is that against ordinary income and investment income?
Against any kind of income.
Wow.
Social Security is not taxable in South Carolina. So many of the returns that we prepare, even though the people have sizable income, once you add $30,000 in deductions for age 65 and older, and you take out the Social Security that gets taxed, then it's really just the investment income, and the taxes are not that onerous at South Carolina's rate at 7%.
That's really interesting. I'm learning something all the time right now, so thank you very much. We're going to be back in just a second. We have a little bit more to discuss about this subject of South Carolina taxes, which is on everybody's mind these days. So please bear with us. We'll be back in just a minute. This is Money Matters, and I'm Emily Johnson. Welcome back to Money Matters. I'm Emily Johnson, and I'm again joined by Tom DeWitt and Lou Wessel of Robinson Grant here in Hilton Head, and we're talking about South Carolina taxes. And we were just discussing actually why South Carolina is such a great state to retire in when it comes to the tax codes. So there are a few other issues that we talked about off camera. If you can bring a few of those up.
Sure. Well, Tom had mentioned the over 65 deduction, which for a couple will bring in a $30,000 deduction. In addition, this doesn't apply to everybody, but there's also something called the survivor's deduction. So if you have
pleasantly named.
Yeah, well, and aptly named though. If you have a widow or a widower who is collecting as a survivor on their husband or wife's pension, there's an additional up to $10,000 deduction for that.
So to be 15 plus 10?
With 15 plus 15 for the couple if they're married, then if both of them were collecting on survivor's benefits.
So if they were both widower,
right,
and they were remarried, wow.
Which we've seen.
So they'd have $50,000 in deductions against their income.
On top of the fact that their Social Security is not taxed in South Carolina, so let's say that's another 30 to 40.
Wow.
Yeah, we're getting some serious dollars, which is why truly, unless you're a fairly affluent senior, you're really not going to be subject to South Carolina income taxes. One interesting statistic that I came across about a month ago is that 60% of South Carolinian seniors are more than half of their income is coming from Social Security.
60%, really?
60%, and a third of South Carolinian seniors, all their income is Social Security. So.
That's really interesting.
Another thing that that I'd want to mention is that on capital gains from investments, whether that's real property or whether it would be stocks and bonds or anything else, is that as long as it's a long-term gain, there is a 44% exclusion from that gain.
44%?
Yeah. So if you have a $1,000 gain, $440 of it would not be taxed in South Carolina.
And that's over and above the $30,000 that the married couple can...
That's on top of it, it is.
Wow. So over 65, you're probably not paying much in the way of state taxes.
Yeah, a lot of people are not paying a lot in income taxes.
And that capital gains deduction applies to everybody. That's not just over 65.
Okay, that's...
So,
yeah.
That's even you.
Fantastic. Hopefully this year, hopefully the market improves so I can this year.
Hopefully we'll have capital gains. That's another issue.
And so speaking of South Carolina as well, I mean, I know that at least in my business, South Carolina has a fantastic 529 plan, Future Scholars, and we use that all the time. My daughter has a Future Scholars plan, and I recommend it. And I know that there are some state tax benefits for investing in the Future Scholars plan as well. Can you tell me a little bit about that relative to other 529 plans?
Sure. I can't speak to the program itself, although my children, they had money in that program as well, and it seems perfectly fine to me. But yeah, we're not unique. There's 2 other states in the entire country, but we are fairly unique in that 100% of the money you put into a 529 plan for your children is deductible from your South Carolina taxes.
And that's unlimited, is my understanding. You can put in any amount unlimited deductible from
$100,000, $200,000, whatever you feel that you want to put in.
Right, and a few things to think about too with that is that the beneficiaries on that don't necessarily have to be your children. They can be your grandchildren, your nieces, your nephews, your next door neighbor even, and you can still get that tax deduction for that contribution.
Correct, and they don't have to go to a South Carolina school. It's really a no-brainer. It's an absolute no-brainer.
And then you have the gift tax component of that too. I know with a lot of my clients, when they're making those contributions for children, for grandchildren especially, they'll want to make that contribution up to the gift tax exclusion limit, which this year is $13,000.
$13,000.
Right, and then of course you can double up as a couple to $26,000. And another benefit of the 529 plan is you can also use 5 years in advance of that. So you can actually put $130,000 for each recipient into that without any gift tax.
And take that against your ordinary income. Take it as a deduction against
in South Carolina.
In South Carolina. Okay.
Now before you get too excited about it, you can't carry it over. So wipe out your South Carolina income and don't go any further than that.
Oh, that's interesting. Okay. That's good advice, because we certainly do use 529 plans a lot. I mean, as expensive as college is now, it's certainly something that we look at a lot. So now let's talk a little bit about South Carolina tax credits, because I know this is an area that I definitely don't understand and is constantly changing. So what are some of the more esoteric tax credits that that CPAs are very aware of and see all the time, but us laymen don't necessarily think about?
The first one that comes to mind, of course, is the 2 wage earner deduction or credit that you get for 2 wage earners, and that credit can be up to, I think it's $400, $300 or $400. And secondly is that there's an education credit on top of everything else, that if your child meets certain requirements, mainly they're going to a South Carolina school, they're not receiving some type of scholarship from South Carolina, from the lottery program that South Carolina has. They haven't been arrested for certain crimes, mainly
drugs.
Yeah. Then you can get an additional $850 credit on your South Carolina return. The one that is most overlooked of all is the insurance credit. Several years ago, South Carolina enacted an insurance credit for insurance on your primary residence. This would be both your hazard insurance, your homeowner's insurance, and then of course your flood insurance, and you add them together. And if that is more than 5% of your adjusted gross income on your federal tax return, you would get a credit for the remaining part. Well, with insurance being so high here on Hilton Head and in any coastal region.
And going up is my understanding.
And going up, is that many people do qualify for this, particularly now that this recession is. We've seen some people that never would have qualified before that qualified.
It's $1,250. It's a big credit, and it's virtually hidden in any of the state literature. The software doesn't really lead you to it.
Really?
So it's something you just have to pay attention to.
And with the low limit on income for hitting that maximum tax rate, all the credits are important, dollar for dollar.
Very important.
Dollar for dollar for these homeowners around here. The other credit, and that we see a good bit of around here, is the nursing home credit. If you're paying the nursing home fees, then you get up to a $300 credit per year.
I've never heard of that one either. That's important.
And that's anybody in the United States you're paying for nursing home credit.
So bottom line is, if people have not filed their South Carolina taxes, they need to go see a South Carolina CPA quickly before October 15th, because it sounds like there's a lot of things that they could miss if they don't. So, come on, this is your chance here. Come on. This is the action season here. So,
yes. The answer is yes.
All right.
You know what? Even if they miss it, you can file an amended return on this. So.
Okay.
All right.
Well, thank you very, very much for joining us. I really appreciate it. I've learned a lot today. So hopefully you'll come back and join us again, perhaps for business taxes coming up, next year, maybe after you've had a break. So thank you very much. We'll be back in just a minute. I'm Emily Johnson. This is Money Matters. Welcome back to Money Matters. I'm Emily Johnson, and I'd like to close with a very quick few parting shots. Mostly, given this market, it's really a great time. I know it's difficult to stomach, but it's a great time to dollar cost average into this market, contribute to your 401k, contribute to your IRA, contribute to your children's 529 plans, grandchildren's 529 plans. This is a great opportunity in a down market to find some good values. In addition to that, you might also consider taking a look at some individual stocks, value names that you might consider buying. Consider what level at which you would consider buying them, make that list, wait for that value to hit. If it does, and consider making a purchase. Now is a great time, if you can stomach it, to find some fantastic opportunities in the market. So that's it for today. Appreciate your joining us. Thank you very much to those of you who have written in with various ideas. That's certainly how we wound up with today's topics, and I really appreciate it. Look forward to many other ideas in the future. Check out our Facebook page at Polaris-Money Matters. Send me an email at emily@polariscapitaladvisors.com. Look forward to hearing from you and look forward to seeing you next week. This has been Money Matters, and I'm Emily Johnson. Have a great week.